In every era, power has had a preferred language. For empires, it was steel. For religions, it was salvation. For the modern world, it's money, quiet, portable, and accepted almost everywhere. But here's the strange part. The money we use every day is not a thing in the way a gold coin is a thing. It's a system, an agreement, an infrastructure, a set of rules, and a set of institutions that decide what counts as payment, who gets credit, and what happens when the bill comes due. So ask yourself, if money is a system, who designed it? And who does it serve? Today's episode is the first chapter in a 104-part journey through the machinery of modern finance. We're going to trace how the modern monetary system was built, from merchants and goldsmiths, to central banks and world wars, to a post-1945 order that still shapes the price of your groceries and the interest on your mortgage. And along the way, we'll keep one idea in focus. Money is never just economics. It's politics written in numbers. To understand modern money, you have to start with a simple problem. Trade doesn't wait for coins. For most of human history, wealth was tangible: land, livestock, grain, and later, precious metals. Coins solved a lot of issues. They were durable, divisible, and harder to counterfeit than sacks of wheat. But coins created their own bottleneck. There were never enough of them in the right place at the right time. A growing economy can outpace the supply of metal, and a long-distance merchant can't easily carry chests of silver across oceans without attracting pirates, taxes, or thieves. So, commerce invented something smarter: trust on paper. By the late medieval period and early modern era, European merchants were using bills of exchange, documents that promised payment in another city, another currency, on another date. These instruments were not money in the classical coin sense. They were claims, and claims can circulate. If you trust the issuer, you can accept the paper and pass it along. This is the first major conceptual leap in modern money. Money as a transferable promise. Then came the goldsmiths. In places like 17th century London, goldsmiths offered secure storage for precious metals and issued receipts. Over time, those receipts began to trade hands as if they were the metal itself. It was convenient, and it created an opportunity. Gold rarely left the vault all at once. That meant a goldsmith could issue more receipts than the gold held in reserve, as long as not everyone demanded redemption simultaneously. This practice, early fractional reserve banking, didn't begin as a grand conspiracy. It began as an everyday business optimization. But it had enormous consequences. It allowed the financial sector to expand the effective money supply through credit. Credit, once a private relationship between lender and borrower, became a public force shaping prices, wages, and growth. Now at the state. As European states fought expensive wars, they faced a brutal reality. Taxes were slow and politically dangerous. War spending was immediate. If a government could borrow at scale, it could mobilize armies now and pay later. The question was how to borrow cheaply and reliably. That's where central banking begins. Less as a technocratic project, more as a political bargain. In 1694, the Bank of England was created in a context of wartime finance. The deal, simplified, looked like this. A privileged bank would help the government borrow. In return, it would receive legal protections and influence over the nation's money. Over time, central banks became the hinge between the state and the financial system. They were not merely banks. They were institutions that could stabilize or destabilize an entire economy. This is the second major leap. Money becomes intertwined with state power. By the 19th century, industrialization accelerated the need for reliable payments, deep credit markets, and international trade settlement. Many countries converged on a version of the gold standard, where national currencies were defined in terms of a fixed quantity of gold, and central banks stood ready, at least in theory, to convert notes into metal. The gold standard wasn't just about sound money. It was about coordination. If Britain, France, and Germany all pegged to gold, then exchange rates were relatively stable. Capital could flow, trade could expand, and long-term contracts became less risky. But there was a trade-off. A gold-linked system can constrain governments. In a recession or a war, the demand for money can surge. Under gold, the supply cannot respond quickly unless gold inflows appear. That rigidity can turn downturns into deflationary spirals, falling prices, falling wages, rising real debt burdens. So even before the gold standard collapsed, the tension was clear: stability for creditors versus flexibility for governments and workers. Modern money rests on a layered architecture, like a building with two foundations. The first foundation is base money, the liabilities of the central bank. Historically, this meant gold-backed notes and reserves. Today, it's physical cash and digital reserves, numbers and accounts that commercial banks hold at the central bank. Base money is what settles final payment inside the banking system. The second foundation is broad money, the deposits in your bank account. Most people assume deposits are stored money, like coins in a safe. But in modern banking, deposits are largely created through lending. Here's the simplified mechanism. When a bank issues a loan, it doesn't hand you someone else's deposit in a wheelbarrow. It credits your account with a deposit, new money, while recording a loan asset on its balance sheet. The bank has created a deposit out of a contract, your promise to repay. That means the modern money supply expands when banks lend and contracts when loans are repaid or written off. In other words, money is tied to debt. This system is powerful because it's elastic. If businesses see opportunity, they borrow to invest. If households feel confident, they borrow to buy homes and cars. Credit expands, spending rises, and the economy can grow faster than the supply of metal ever allowed. But the same elasticity can amplify booms and busts. If lending standards loosen, credit can inflate asset bubbles. When those bubbles burst, banks pull back, money creation slows, and a downturn can deepen. So where does the central bank fit? Central banks became the lender of last resort after repeated banking panics made the problem obvious. If trust evaporates, even healthy banks can fail in a run. When everyone demands redemption at once, fractional reserves become a vulnerability. By providing emergency liquidity, lending reserves against collateral, central banks can stop a panic from destroying the payment system. In exchange, they gain tools of influence. They set the policy interest rate, regulate reserves and liquidity, and in modern times, buy assets at scale through open market operations and quantitative easing. Think of it this way. Commercial banks decide who gets credit. Central banks decide the price of that credit and the survival rules when stress hits. And the state adds the legal layer that makes all of this enforceable. Taxes must be paid in the state's unit of account. Courts enforce contracts. Deposit insurance, regulations, and bank charters create a framework of permissions and constraints. This triangle, banks, central bank, and state, is the operating core of the modern monetary system. If the early chapters of modern money were written in merchant ink and wartime debt, the decisive rewrite came in the 20th century, when two world wars shattered the promise that money could remain tethered to gold. During World War I, many countries suspended gold convertibility to finance military spending. The logic was simple. You can't fight an industrial war with a money supply that depends on metal shipments. Governments issued debt, central banks supported war finance, and the money supply expanded. After the war, some attempted to return to pre-war gold parities. But economies had changed. Debts were heavier, prices had shifted, and political demands, especially from workers and veterans, made deflation harder to impose. The interwar period became a laboratory of monetary stress, competitive devaluations, banking failures, and the Great Depression. By the time World War II ended, leaders faced a choice: rebuild the old world of fragmented currencies and recurring crises, or design a new architecture. In 1944, representatives from dozens of countries met at Bretton Woods to construct a post-war monetary order. The core idea was a hybrid. Currencies would be pegged to the US dollar, and the dollar would be convertible to gold at a fixed price, at least for foreign governments. The United States, with its industrial strength and gold reserves, became the anchor. Alongside this, institutions were created to manage the system: the International Monetary Fund to provide short-term balance of payments support, and the World Bank to finance reconstruction and development. This was a turning point because it formalized something that had been emerging for centuries. Monetary stability would be managed, not discovered. The world would rely on institutions, not just metal, to coordinate trust. But Bretton Woods carried a built-in tension. The world needed dollars for trade and reserves. But if the U.S. supplied too many dollars relative to its gold, confidence would erode. The system depended on both American discipline and global belief. That tension didn't explode immediately. For a generation, growth was strong, trade expanded, and living standards rose in many countries. Yet underneath, the mechanics of credit and geopolitics kept evolving. Financial markets became deeper. Cross-border capital flows grew harder to control. And the demands of domestic policy, jobs, inflation control, social programs, began to clash with the constraints of a gold-linked promise. The modern system was built on the idea that trust could be engineered. Bretton Woods was the blueprint, and its eventual strain set the stage for the next chapter of this series. Even if you've never heard of Bretton Woods, you live inside its legacy. The idea of central banks managing the business cycle, raising rates to cool inflation, cutting rates to fight recessions, became mainstream after the mid-to-late century. The expectation that governments will borrow during crises is now embedded in policy playbooks. And the US dollar's role as the world's primary reserve currency still shapes global trade, commodity pricing, and international borrowing costs. Modern money also changed what power looks like. In earlier eras, power meant controlling territory and tribute. Today, power often means controlling financing conditions, who can borrow cheaply, who faces capital flight, whose currency is trusted, and whose institutions can backstop a crisis. This doesn't mean the system is rigged in a cartoonish way. It means incentives are asymmetric. Large states with credible institutions can issue debt in their own currency at relatively low cost. Smaller or less trusted states often borrow in foreign currency and face harsher constraints. When shocks hit, the difference between safe and risky can reshape politics overnight. At the personal level, the system affects how you experience life. If credit is cheap, home prices tend to rise faster. If inflation accelerates, wage negotiations become political battles. If central banks tighten, unemployment can rise before prices fall. And because money is created through debt, societies can feel like they're running on a treadmill. Growth requires borrowing. Borrowing requires confidence, and confidence can vanish in a panic. Understanding how the system was built helps explain why debates about inflation, debt, and central banks feel so emotional. They're not just technical arguments. They're arguments about who bears risk and who gets protection. So, how was the modern monetary system built? It was built in layers. Merchant credit on top of metal, banks on top of merchants, central banks on top of banks, and global institutions on top of national currencies. It was built through practical solutions to real problems: security, liquidity, war finance, and international coordination. And it was built through political bargains about who gets stability, who gets flexibility, and who pays when things go wrong. But one question still hangs in the air. If the system began with promises redeemable and something tangible, why did those promises gradually lose their backing? In the next video, we'll follow the thread that Bretton Woods left exposed and ask, why did money become unbacked in the first place? And what did governments gain and risk by cutting the last ties to gold?